Rivian and Lucid are two automakers that could benefit from the sweeping tariffs announced by President Donald Trump. Rivian and Lucid have manufacturing facilities in the United States, and they could compete more effectively if their rivals that are importing vehicles and importing parts, significant percentage of their vehicle parts from outside the United States. If anything, I think the tariffs are going to be good news for Rivian and Lucid, given their competitive positions were so poor before the announcement of the tariffs. These could be the catalyst that could send some business their way. But which one of them is the better buy for investors that are looking to capitalize on their increased position competitively? I'll answer that question in this video, reviewing the two EV companies across several important metrics. And I'll also share with you my proprietary discounted cash flow models for Rivian and Lucid, revealing what I feel is the fair value of these businesses. And then I'll answer the question of which one I think makes the better buy today.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
The first thing I wanted to look at is revenue growth for these two businesses. They've both experienced a bit of a ceiling here in terms of increase in consumer demand. Rivian's trailing 12-month revenue figure of $4.97 billion is likely to get worse in 2025 and not better. The company is forecasting a production number that's lower than what they produced in 2024. They're also introducing price cuts and incentives that is likely to lower the average selling price of those vehicles that they do sell in 2025, with no new models coming out until 2026. That is a big new R2 lower priced lineup. So it remains to be seen how much of a benefit they get from higher competitor prices. They just announced their first quarter vehicle delivery numbers, which were underwhelming. They reiterated their full year 2025 number. So far, they haven't seen any reason to increase their target. We'll learn more from the company's management team over these next 4 to 12 weeks if they are seeing any positive impact from being a primarily US-based business in terms of the components and everything that goes into their electric vehicles. Lucid, meanwhile, has better growth prospects. The company just introduced the Lucid Gravity SUV, which in my opinion is a beautiful car, much more attractive than the Rivian models. That is, of course, just based on taste. And I just like the way the Lucid cars look compared to any other electric vehicle on the market. And the management team is already seeing positive results from that. They've highlighted they expect deliveries to roughly double year over year. So their sales numbers, while they're starting from a much smaller base, they delivered roughly 10,000 units in 2024. They're expecting roughly 20,000 units in 2025. So this is an actual growth company that is growing. Rivian, meanwhile, investors in Rivian, they have to wait until 2026 to see if this company will continue growing, to see if that lower priced model will come out around $45,000 as announced or as planned. And then they have to see how much consumer demand there is for that model at the $45,000 price point, and if that actually helps Rivian's business. Because what it could do is cannibalize sales from the higher priced models, and instead of Rivian's revenue overall increasing, it just kind of stays flat as consumers, instead of buying the $80,000, $90,000 models, choose for the lower priced models instead, and the overall revenue of the company doesn't actually increase. So there's big question marks around that, and that remains to be seen. The cash flow from operations on a trailing 12-month period look pretty awful for both of these companies. At one positive, Rivian has been improving its cash flow from operations. At one point, it lost almost $6 billion on a trailing 12-month period in cash flow from operations. That's improved dramatically since then, up to negative 1.7 billion in the most recent trailing 12-month period. Lucid, meanwhile, has not shown that kind of improvement. This year might be the year that they demonstrate that, with the sales of the SUV now complementing the sales of its sedan and nearly doubling the number of units delivered. That has the potential to improve the company's bottom line and improve the cash flow from operations. However, it's still likely to be negative, and the analysts on Wall Street that are following Rivian and Lucid, they expect these two companies to be negative in cash flow for several years into the future. And I agree with those forecasts because the catalysts for growth are not that exciting. What is needed here in this industry is huge improvements in technology, not incremental improvements. Electric vehicles for most people, and I sound like a broken record, they're more inconvenient and they cost more money. And so it just doesn't make sense for over 90% of households. It just doesn't make sense. For a small fraction, less than 10% of people, it makes sense. But for everyone else, it just doesn't make sense. There needs to be greater innovation here in especially battery technology. There needs to be faster charging, longer battery life, etc., to attract people to this industry, because as it is now, it's just not very attractive. And the money that's gone into it, the investments that have gone into it, have not bared the fruit that was expected from investors worldwide. And as you can imagine, the returns on investor capital are also significantly negative. Negative 46% for Lucid, negative 39% for Rivian. Very little improvement in these metrics here for these two companies. One major achievement here has been Rivian's gross profit margin positive in the most recent quarter. But again, that came with a lot of asterisks. Much of that gross profit came from the company's sales of regulatory credits. So it was more of a government incentive thing rather than the actual company organically generating positive unit economics. That really wasn't the case. So a lot of question marks still remain whether these companies can turn profit positive and when that will be the case. How many years later will they will it take for them to achieve profitability? And as investors are waiting that whole time, that's money that investors could have been making with another investment. So if you're waiting 5 years for Rivian and Lucid to turn profitable, you could have earned, help, 4%. You could have earned 4%, 4.5% in US government bonds for 5 years. That's an over 20% return on your money while you're waiting for these companies to maybe become profitable 5, 6 years later. So let's look at valuation. And when I conducted and calculated my discounted cash flow for Lucid Group, as I highlighted, the analysts on Wall Street, they expect the company to lose money, negative free cash flow all the way through to 2029. So I have the company breaking even in 2030 and generating some positive free cash flow in 2031 and improving from that point onward. I'm being very friendly with the company's longer term growth trajectory. I'm giving them a 7% growth rate longer term for the fact that it's going to take them so long to get going in terms of increasing production and sales. And so it's going to be a longer tail in terms of the cash flow increases. So I'm giving them an attractive longer term free cash flow growth rate. Still, even after that, I'm calculating an intrinsic value per share of just $1.14 for Lucid Group. The current market price is $2.40. Similarly, for Rivian, lots of negative free cash flow expected for several years, all the way until 2029. The analysts on Wall Street expect the company to continue losing money. I have the company turning cash flow positive in 2030, and that's a big question mark if they are able to achieve free cash flow positive. 850 million I'm forecasting. And even after that friendly forecast, the intrinsic value per share comes in at $6.07 compared to the current market price of $12.50. So it looks to me like these two their stock prices need, and they're already down, 80, 90% off their all-time highs. Looks like it needs another 50% lower for them to become attractive investment opportunities. Now, I'm biased because I dislike the electric vehicle industry. I dislike the car industry overall. Two of my least favorite industries are the airline industry and the car industry. The profit margins in these industries are notoriously small, very risky, difficult, cyclical businesses, unattractive for me as an industry, right? So take my analysis with a grain of salt, given my bias against the car industry. Okay. Now, if I had to pick between these two, I hope I never have to make this decision because I don't want to own either of these two companies anywhere near these prices. Maybe at, 50 or 60% lower, I would consider them. But if I had to pick between one of these two at their current prices, I would probably choose Rivian, but it would be a close call as they both seem equally overvalued. Hey everyone, we've got some exciting news to announce. We launched a private Discord exclusively for our channel members at the VIP Discord tier. It's your backstage pass to ask questions, share insights, and get direct access to me. Don't miss your chance. Limited spots available, so join now.